Oh my gosh, I never thought I would see the day. Folks, you know that I use the Bloomberg Terminal. I do a lot of research on the Bloomberg Terminal. I do a lot of research on Refinitiv, which is the Reuters version of that. I also go through hedge fund letters and bank letters. I mean, I go through hours and hours of research every single day. And there's this one guy who's been like this perma-bear all year long. He's called the Macro Man. And he does this like twice-ish a week column where he basically poops on the market. And he's been so freaking negative all year long. And you know what? Rightfully so. I started the year out really negative as well. But then I started seeing the light at the end of the tunnel, and now I'm like 94% in the market, and the cash I have is probably gonna just go into the Series A that we're launching, and then basically I'll be all in, right? So like obviously at some point I U-turned and became bullish again, which is what I said I would do at the beginning of the year. I'm like, I'm gonna sell, sit out some of the pain, and then rebuy. Okay, great. So what happened with this Mr. Macro Man that's so interesting? And what does it mean about the potential bottom of a market? Is he potentially a signal that the U-turn is in? Well, I want to show you his article because I have to say there are so many lessons in this. You're going to explode. Okay, maybe not, but take a look at it, okay? We'll go through it together. He says, one of the biggest challenges in the investment game is to properly synthesize and assess the flows of incoming data. This is a really good point because it's like there's so much freaking data. It's quite rare for developments to tilt entirely in the direction of one's investment thesis. That's true. You might be really bearish on the market right now, but then there are bullish things going on. It's like, damn, you know, that doesn't line up, right? Nothing ever is always in one direction. And he says, ultimately, investors have to make a decision. He's basically prepping for his flip-flop, okay? It's glorious, so we have to go through it. Investors have to make a decision about whether to change their position. Observers, on the other hand, merely have to determine whether to change their view. So he's making this argument that, like, people who just observe the market, maybe like reporters or people who make YouTube videos that don't actually put their money where their mouth is, like, they just kind of talk about it. Well, they could just kind of talk about what's changing, but investors actually have to make a decision. Do you put your head on the line and make a move and then tell people about it, right? For the most part this year, this column has sketched out a pretty negative framework for equities and risky assets. That view is being challenged, however, as the S&P just put in a pattern of behavior that marked 5 of the most significant market bottoms of the past 50 years. You don't have to. This gets so fascinating. I mean, I love what he did here. Basically, I'm gonna scroll past this next stuff here about people like basically wanting to protect their brand because they don't want to change their opinion. You know, people don't want to be defined a flip-flopper, and that's basically what he's saying here. Like, there are plenty of market participants who basically only present facts that support their publicly disclosed thesis, because if you talked about other facts, well then you would be contradicting what your position is, right? I don't want to do that ever. Like if I see something that's like, wow, damn, that doesn't align with my thesis, then I have to actually look and go, well, maybe it's time for me to flip-flop, right? And this is what's so fascinating about investing. Anyway, this guy been super bearish, right? Okay, listen to this. This is remarkable. So what he did is watch this. How often has the market followed up a huge monthly decline with a rally of a similar magnitude? Going all the way back to 1928, this person filtered every occasion in which the S&P 500 followed up a monthly drop of at least 7.5%. So let me make that really, really crystal clear. What he did is he basically filtered the S&P 500 and said, hey, give me months that had a 7.5% decline. Then show me times, like years, periods of time, where the very next month was up 7.5%. This is literally what just happened, okay? June to July, negative 7.5, up 7.5. That's a big deal. It's a big move. And the returns before the war, right here, were kind of bad. They were pretty paltry. In fact, if you look at the returns before World War II, you'll see that 12 months out in 1931, you would have lost an extra 70%. an extra 17% in 33, an extra 3% over here when that happened again in 33. You would have gotten 12% return only after being up 35% after 6 months, but then ending up only 12% up after a year in 1938. So not so great, right? Like before World War II, not great. In fact, after a year here, you had that negative 1% return in 1940. But then when the Fed actually started getting more active, look at the second half right here. Look at this. After the Fed's involvement in the market, you basically, in a 1, 3, and 6 month period, almost always had positive. In fact, let me highlight the positive. 3, 6, 12 positive. 6 and 12 positive, 1 positive. All positive in 2009. All positive in 2019. All positive in 2020. You only had a 1 month period here in 74 and a 3 month period here where you actually had negative return. Look how freaking green that is. Like, I shouldn't even have Fed easing in that same color there, so let's highlight. This right here, bullish. This is great. And I love that he eats it because he says it here. In fact, if you take a look at the 1974 to 2020 average, it's positive all across on average, but before the war, it's actually negative. Kind of interesting. Okay, but anyway, listen to this. The columns in this table show, okay, well, I already explained what all this says. Oh, yeah. Look at him put this on a chart, okay? Like, if this doesn't make you bullish, if this doesn't make you want to use coupon code Series A to get the best price we currently got on the courses with me, Kevin, I don't know what you're up to. Maybe you just need 50% off with Seeking Alpha by going to metkevin.com/seekingalpha. They made the deal really sweet. Go there, metkevin.com/seekingalpha, and you see it. But look at this chart. Oh, my gosh. Okay, here we go. S&P 500 monthly rallies of 7.5% following a loss, right? Where were those? Okay, where were those, folks? Look at that. The depth right here. The depth right here. That was in the early 70s. This is by the dot-com bubble. This is in 2009. This over here in 2019 and 2020. Folks, if you literally want a post-World War II market bottom indicator, it is literally this. A negative 7.5% month, at least a negative 7.5% month, followed by at least a positive 7.5% month. And so what's really kind of interesting about this is after this, he says, anyone running money now has to decide whether the price action of the past couple months and the precedents of the last 50 years have any relevance for a change in investment stance. Really interesting. These days, my job is a bit easier. It's to help you, the reader, make the most informed decisions. This guy's great. I really, really appreciate this person. And even though I don't always agree with everything he says, I love reading his perspective. And he's basically telling you, like, you got to ask yourself, like, dude, when the macro man flip-flops and like, oh, damn, maybe the bottom isn't. Maybe it's time to start scratching your head and wondering, why are you sitting around? Get in the freaking market. I don't know. This was really exciting to me. I had to share it. Hopefully you found it helpful. Let me know what you think by going to metkevin.com/chat, which is our Discord. Tag me and let's chat it up. Thanks, folks.